Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. The government last week slashed interest rates on small savings schemes such as the Public Provident Fund or PPF, the Kisan Vikas Patra and Senior Citizen Savings Schemes. Rates on PPF have been cut to 8.1% for the period April 1 to June 30th from 8.7% currently. Interest rates on Kisan Vikas Patra reduced to 7.8% from 8.7% presently, and for Senior Citizen Scheme of 5 years, rates down to 8.6% from 9.3% currently. Now, while this move obviously means a more market-linked interest rate structure, it might be difficult to digest for millions of Indians whose life savings are in such schemes. The question therefore is, are savers really worse off at this point with these lower interest rates, and could they be benefiting, if at all, in the longer term? And more importantly, what does the outlook depend on, or what should you be watching out for in order to understand whether you are benefiting or not? To discuss this, I'm joined by Saugata Bhattacharya, Chief Economist, Axis Bank, and Anjali Verma, Economist at Phillip Capital. Saugata, let me begin with you. So this came as a surprise, the sudden drop in interest rates, but obviously it's been building up and there is a context to it. Walk us through that.
Well, I mean, remember that there are multiple facets. The first thing that you talked about, that it immediately hits the interest earnings of many people who subscribe to these funds. The idea of these funds essentially were to provide at a time when there were lots of market administration and so on. People were looking for safe assets at a time where banks were not considered to be all that safe prior to nationalization, all of that. That situation has changed. So now,
but you're saying it goes back that far?
Yes,
the thinking,
it does. The thinking of these small products, I mean, particularly the agricultural saving schemes, etc. So now that the entire structure of banking has changed, the entire system of finance is more market linked and market determined. I think what it does is that artificially fixing rates for some classes of products is not a good idea. Remember the entire principle of subsidies. Don't tamper with prices. I'm sure there are a lot of people, the pension people, pension families, people who are below the poverty line, or I mean lower income families, etc. Those families need to be supported, but they should be supported just like the government is moving into various DBT schemes for other systems. There should be upfront cash transfers to those families, but don't mess with the interest rate structure. What happens is that with policies, I mean the attempt from the RBI to reduce the entire structure of interest rates that you were talking about, that was beginning to flounder because there was some diversion of money that should ideally have come to banks, enabling their pool of liquidity deposits to have increased and allowing them to lower rates. That was moving into these fixed rate products, and that was interfering. What happens is I lose out on interest, but don't remember that with lower interest rate, growth is supposed to increase. There are other factors, but growth is supposed to increase, and that would increase incomes.
Right. So, Anjali, let me get your view here. So, this is good for the larger good of the country, but is this something that I should be sacrificing?
So, like Saugata said that RBI has been reducing rates in order to bring in more sustainable economic growth. However, banks were not able to transmit it because the most important reason that they were giving is that a government is offering such higher interest rates, and that's the reason all the savings are moving to the government. And in turn, if we reduce the rates, our deposits will go down, and how will we fund the lending, right? So this was the most important reason that banks were giving, in order to not to pass on the monetary policy benefits. So with this, I think the biggest logic will be that banks will be incrementally reducing the interest rates, and therefore the lending rates, the entire structure of lending rates will go down, and therefore it will be beneficial largely for the corporates to begin with.
And we'll talk about the overall lending rate scenario in a moment, but we were also told, Saugata, that one reason the banks are not transmitting is because of their stressed assets. So to what extent is this important, or is this more important than the other?
I think it's a combination of everything. It's a combination of the liquidity situation. Remember that liquidity this year has been extraordinarily tight compared to last year in particular. Forex flows have not come in, so that's contributed to liquidity. The government has retained much of its balances. It's not been spending as much, so that's also contributed to this. Plus, the entire cost of provisioning. You've seen some of the public sector banks take losses because there are increased provisioning costs. So all of these have contributed to the state where interest rates, banks were not able to interest rates to the extent that the Reserve Bank would have liked them.
So more practical question, given the new interest rate regime for the next 3 months, since we are now going to be pegging them quarterly, am I going to be worse off because we also have the inflation factor to keep in mind?
How exactly do you mean we worse off, meaning banks worse off?
No,
like
I
individuals?
mean me, the saver.
The saver. I mean, obviously the hit will be immediate. The hit will be immediate.
Yeah.
Going
But my
forward.
question is that if inflation is lowering, am I really better off compared to what it could have been, let's say, a few years ago?
Well, I mean, inflation is definitely, I mean, the costs and balances, inflation has already come down.
Yeah.
Savings were still relatively up. So we have benefited, I mean, what economists would call the surplus that they would
But
get.
is that real, or are these just these numbers floating around somewhere?
No, it is real because I mean the CPI basket is now much more representative of the true cost of living. I mean the fact that CPI has come down from 10% to 5% definitely has opened up the extent of discretionary incomes that the families.
Okay.
On top of this, families. And remember, I mean, at the end of the day, the PPF, EPF, all of these structures are still relatively small compared to the volume of bank deposits. So, I mean, it's not as if, I mean, both are half and half. So, to that extent, I mean, people did benefit, but overall, the notional gain that families would have from these higher interest rates would be relatively small as in proportion to the full incomes that they have from jobs. As I said, the two main streams, I mean the pension, the senior citizens, and on the other hand, lower income families. And lower income families, remember, again in the PPF, this is what the economic survey also pointed out. Again, it's that 80-20 principle. The largest savers who probably do not need that kind of PPF support are the ones who are the main contributors to the PPF corpus.
Right. So, Anjali, are you seeing this as a well orchestrated effort then? I mean, we talked about it in the budget and we've now seen a cut in interest rates and small savings, and we'll come to the next move, but is this following a path?
It is. So what government is trying to do here is to stabilize the financial system. So you like you said, currently banks are suffering with huge NPAs. So that government has tried to address the first initially, and now they are trying to address the second level of transmission, monetary policy transmission. So with this, and I think they announced it in the budget and they have implemented it quite soon. And the drop is also quite significant. So I think banks eventually will have to respond. Maybe beginning April is when we should hear some positive news from banks.
Right. So what is the future for small saving schemes, Saugata?
Well, I think there's still, I mean,
assuming everything gets evened out, which is the
right.
objective here. Yeah.
That's right. But I mean, even now, compared to the G-Secs, compared to bank deposit rates, I think that you still are getting a premium. So to that extent, that some of these savings, remember, are also not taxed at various points. Although there is talk now of moving to a EET, taxing the final corpus at the end. But you still have tax advantages. The rates anyway are higher to different extents, but the rates are higher. So I mean, the families that would prefer to invest in those, the incentives might have weakened a little bit, but there is still ample opportunities, should you want to do that, to get some little additional incomes out of this. Essentially, what we are trying to do is to move to a pension society. We are trying to move from a defined benefit, which is what the PPFs more closely resemble, to something like a EPS, which is the pension scheme, the NPS, the National Pension Scheme. So, I mean, it's a defined contribution type of scheme, which is what leads to sustainability in the long run. Imagine the kind of trouble that the European economies with aging populations and things with defined benefits are facing. We do not want to get into that situation.
Right. So, inflation being one important factor in the contribution to this decision, assuming inflation levels start going up, what happens then? So, let me ask you first.
I think looking at the projections that we have or what we can see going ahead, is overall inflation is going to be within RBI's comfortable zone. So I mean, for let's say financial year 17, it should be somewhere hovering around 5% or even below. So somewhere in the range of 4 to 5% is where it will be, which is quite a comfortable zone for RBI. Unless a problem comes from bad monsoon and commodity prices, I do not see much problem on the inflation front, at least for this financial year. However, of course, we have to keep in mind that RBI still wants to get a 4% target by FY18. So that at the moment still looks slightly challenging. However, I think for this financial year, we at the moment it looks we are in a comfortable zone.
Right. So the government is saying that it's going to relook at the number every 3 months.
Yes.
Now, is that something that I should be concerned about as a saver again, because I'm really not pegged to one rate as I was all these years?
So see, like you said, if inflation starts to move up, then it will make sense to revise the rates upward, right? So therefore, it is more logical, and I would say rather more comforting for depositors that the rates will be, relooked after.
And you're saying that I
quarter.
can trust the government to maintain that differential?
I
to some
think
extent?
we'll begin with that. Why not?
Saugata?
Absolutely, 100%.
Okay.
I think that we are pretty much now to an equilibrium differential between the benchmark GSEC rates and the other rates. I think they will maintain this differential. There might be a couple of products where you will move. But even here, I mean, the February notification and then the March notification, they make it very clear that this is graded. I mean, the differentials for products that are targeted to the elderly, to the pensioned, to the retired segment of the population, and to the vulnerable segments of the population, that differential anyway is higher.
Right. So, in short, you're saying that the outlook for small saving schemes looks reasonably positive. There will be a positive differential to bank rates. Interest rates in banks, and therefore people should continue to stick with them.
I couldn't have put it better than that.
Okay, so we'll take a break on that, but we'll come back on the other side. We'll talk about interest rates now and what that could do, particularly if it goes down, and of course there's a liquidity surge in the market. Stay with us. Welcome back to Policy Watch. There's a general expectation that interest rates will be cut anytime now. Partly in anticipation of this, the stock markets have started strengthening ahead. Though to be fair, expectations have been high ever since the Union Budget 2016 was presented on 29th February. So what are the prospects for a lower interest rate regime, and what can it do to liquidity and the overall economy? Would lower interest rates mean that the cost of home loans, for instance, could actually become lower now, or are there still hurdles along the way? What is the financial sector looking out for, and how could you benefit? To discuss this, I'm joined by Saugata, Bhattacharya, Chief Economist of Axis Bank, Anjali, Verma, Economist, Phillip Capital, and Ajay, Garg, Managing Director of Equirus Capital. Thank you all for being here or staying with us. So, Ajay, let me begin with you. So, the markets have started rising once again. Now, this expectation was already there when the budget was announced. So, what's changed?
So, I guess the fiscal maths which the government gave gave a lot of benefit, comfort to the market that the RBI is getting RBI governor is getting whatever scorecard it had given to the government to achieve, followed with the way the administered rates on the small savings have been also reduced, and that's a very significant reform in our mind, where they are talking of linking it to market rates rather than being administered. And given those 2-3 factors, markets have already factored in a 25 bips reduction in interest cut, and expecting in the April policy for that to happen. And I think as the market is seeing the reduction or lower in the interest rate, and we have seen, if you sort of look at the stocks that have run up also, specifically capital asset stocks have run up significantly in the last 3-4 weeks post-budget.
Okay. Right.
And I think that's where the direction of the market
And what's the view on banking stocks at this point?
So I guess banking stock, people are still confused in terms of, how much of NPAs would come out. If in case RBI governor does and tries to be ahead of the curve and he does it before 31st March, then we may have some more treasury income also for them. But otherwise, it's sort of, banking stock is people, there will be some correction, but people still will see the direction in terms of what sort of write-offs they take in this quarter.
Right. So, Saugata, if we are heading for a lower interest rate regime, which by all accounts we are, what does this world look like?
Good. For one, I mean, backing up a little bit, I think one of the reasons that why all asset classes have rallied is also a set of global factors. I mean, commodity prices started going off. There was a risk-on environment that came in with all emerging markets. The rupee strengthened, but so did the currencies of most of our other emerging markets. So all of this is part of the global. In addition, in the idiosyncratic factors in India, particularly the good budget, potential for RBI rate cuts, etc., have been driving this. As you said, as you mentioned, I think overall, if you lower the entire structure of rates, not only is this beneficial for individual borrowers, retail borrowers like you and me, who get to borrow because, I mean, the borrowing habit has increased because asset classes, our assets are increasing. So the cost of borrowing has come down, but overall for the general economic activity, even if costs of lending come down by 25, 30, 50 basis points, I think in addition to all the measures that the government is taking, all the reforms that they are putting in place, I think a little boost to those measures would come in from the cost of borrowing.
Okay, so let me come to the institutional part in a moment. But Anjali, do you think that the question, which is what most savers would ask is, or investors would ask is, will the cost of my funds, which is my loans, my home loans or car loans, will that come down? Now, there have been several false flags in the past. What is the guarantee or the comfort that it could be different this time?
I think it is bound to be different this time because, like I said, for banks, the biggest hurdle has been higher interest rates from the government, which has been slashed by let's say about 1%. and so that is one transmission which will happen. Then banks will be shifting to marginal cost of funding, which will start in April. So that is second. Third is that there is impending transmission of the previous rate cuts. Okay, so all of this together, and then we are expecting additional, let's say 25 to 50 bips cut from RBI. So I think there could be a reasonable fall in lending rates, and this time I think it's going to be implemented.
Right. Yeah. Okay, Saugata, this time will be the time.
Sure, because everything that Anjali said. In addition to which, remember that banks have indeed passed on with that 125 basis point cut in the repo rate. Banks have transmitted about 65, 70, 75 basis points. I think this is.
But to everyone, to all classes?
Everyone, with different degrees. 10, 15 basis points to different categories of borrowers. But I mean, overall, the rates have come down. I think over the last 6 months, what in addition to the rate cuts, what the RBI has started doing through these open market operations is trying to infuse more liquidity. So right now, I think, in addition to the fall in the basic rates, a degree of infusion of liquidity through OMOs, LAF, or other means will also aid in bringing down the overall cost of funds. Traditionally, the fourth quarter is always a tight liquidity situation, which will begin to reverse in the April and June quarters. So if that actually happens, I think there is enough scope for banks now to follow.
Right. So how can we link all of this to the overall prospects for the economy for at least the next 3 to 6 months?
Well, I mean, interest rates are definitely one part of the story. But in addition, I think the other measures that the government is taking in terms of some of these construction projects, roads, urban development, power transmission, etc., I think those products are likely to become visible in terms of economic activity. So that's one thing that is likely to happen. If they pass a little bit of some important reforms, bankruptcy, hopefully, and we all hope and pray that some magic on the GST bill happens.
Right.
So if that actually happens, there will be an enormous surge in investor confidence. Foreign capital will begin to come in, and that will begin to provide more liquidity into the markets.
Right. So Ajay, just to pick up on that and continue with that, so we're looking at 2 or 3 strands of hope when it comes to the economy as a whole and in investors and savers individually. What's your sense? What's your outlook from a market perspective, 3 to 6 months?
I think clearly based on the way we are seeing in the interest rate expectations, and if you saw the flows in the markets also recently, clearly we are gearing up for a very good FY17 in terms of the way the markets would perform. We still have concern about the earnings, the way it will play out, but if the cost of borrowing comes down, it is always going to be very good for the equities market, in an overall context. So FY17 we expect will do much better than what happened in FY16. As we had anticipated earlier also, that the first half you may not see much, and which has borne out, but second half would obviously be a significant movement out there.
Okay, Anjali, are you equally bullish on the second half of FY17 as
second half? Yes, but nothing significant I'm expecting to happen in the 3 months.
Okay.
So 6 months onward, I think some improvement will be visible in the macro data, because even as recent as February, macro data is not looking all that positive, barring inflation. So GDP, IIP, core sector, so things are not looking exports. So all the macro data is not reflecting any positivity at the moment. Lot is getting built in the stock markets. Announcements are there in the budget. Implementation, even if it starts now, will start to have an impact 6 months down the line. So maybe 6 months things should look better.
Right. So since we're talking about interest rates in this program, Saugata, so to what extent, the question is then, can the interest rate drop that is most likely going to happen in a few weeks provide the trigger that we are waiting for?
Well, I mean,
alone.
I think markets are expecting, so am I, and I think we'll probably very, very likely get a 25 basis point, 0.25 percentage points cut in the repo rate.
And this will have universal impact, as you said, on individuals, companies,
it will throughout. I mean, because this will get the entire rates and aided by the developments in the small savings rates. I mean, so the entire structure of interest rates will begin to come down. So that's one. I think other than interest rates, all of us talked about various things. One thing which is a wild card as of now is agriculture. If we get good rains this time, I think the transformation will be fairly dramatic. In the impairment that we have had from the rural economy, that will flip around, and that's going to take GDP, I have no doubt about that, if we get normal rains, beyond 8%.
Okay, but you're saying agriculture can actually counter the effects of a slowdown that we've been seeing, or a sharp slowdown that we've been seeing in the last couple of years?
Very much. I think
just the rain, you're saying the rain will lead to, okay.
Through via demand channels, via output, etc. I think this will counter, because capex is not going to increase very dramatically anytime. Whoever the government, the private sector, foreign investors, whatever they do, capex is not. So we need some turnaround in demand, and that's going to come in from agriculture if the rains are good in particular.
Okay, so the big triggers.
On the agriculture, I have a different opinion. Agriculture GDP could look better if there is good monsoon. However, on the demand front, my opinion is that it could take longer, because farmers have
rural
been
demand or
rural demand.
Yeah, okay.
So farmers have been troubled for last 3 years. So even if this monsoon is good and there is good agriculture crop, so I think that for them to increase demand will take longer.
Okay.
So I would say at least 2 seasons would pass before the demand starts to increase from the rural.
And you mean 2 good
side.
monsoons?
Or at least this one entire financial year, so good Kharif and good Rabi crop, and after that I would expect demand to start improving from the rural front. Rural thrust that government has given will again have a positive impact with a lag. So another 6 months down the line. Urban consumption is where I think the strength could continue. And depending on when, to what extent the pay commission is implemented, I think the urban consumption demand could persist, but I still feel that rural consumption will take longer.
Okay, Ajay, so what are the triggers that we are looking at then? So you talked about earnings, and that's really more of a concern than a positive.
I think with this interest rate scenario more or less being factored in, whether it's a 25 bips or a 50 bips.
And assuming that this will also give a general push to the entire economy, and not just some sectors
Absolutely.
of it, okay?
That's sort of already been factored. I think the next trigger which the market will obviously look for would be in terms of what sort of earnings really come out in this quarter. And I think we're not really seeing so much sign in this whole FY16. We have not seen the sign, and obviously market is not expecting the last quarter results to be terribly good, because I was looking at the FY17 and thereafter numbers. But some sort of indication at that would sort of endorse the view, and I think that's where the next trigger would be in our mind in terms of how the results will come out.
Okay, and what about the external conditions that usually the markets get affected, and how are you looking at it?
So I guess people are factoring in the fact that the oil has now gone back to $37 to $40, and if in case it remains broadly there, a few points here and there, they're broadly okay. China, where obviously no news is good news, or that's the way sort of people are thinking about it.
And what about interest rates elsewhere in the US and the European?
So I guess that's what you're sort of telling also, that in terms of, if you sort of look at the way the Fed in the US took about took such a long time to really hike the rate, and that's why you want our governor to be a little bit ahead of the curve, because good part of what they could have hiked the rate would have been earlier part of the year. Obviously, as they come onto this thing, they have not really been able to hike this. They postpone this. So with the elections round the corner, and where the US data is looking much stronger in terms of what we are seeing this, but we don't expect
So I was trying to link that. I mean, by asking a question on interest rates externally, I was trying to link that to liquidity flow. So therefore, they could not. I mean, you're not expecting any major surges.
Not for the incremental changes we are talking right now that will have such an impact. But I think the India structural flow was obviously more driven by the fact that it's still a 7-8% growth economy.
Right. So the flip side. So we've talked about some of the factors that could contribute to growth or change internally. There are the external factors that we've touched upon. What are we missing out? What are the negatives that we should be concerned about or be alert to?
Well, the negatives, I mean, from the foreign side, we have potential for negatives galore. I mean, with the negative interest rates and so on, the effect that it would have on foreign banks, the currency volatility, currency movements, investor pulling out money and things. So those risks remain.
Yeah. But the positives we've discussed so far will, in some ways,
I think the balance has now become much better, much better. So I mean, that's there. Domestic rains, the third deficit monsoon in a row, is definitely one aspect. Other than that, I think structurally we have moved to a much more stable system, whether it be the fiscal side, whether it be the external side, forex reserves, the government debt, etc. I think we are structurally much more sound. Right now, again, I mean, as people expect, I mean, because expectations have now again gone beyond what reality is. So, I mean, if the government now fails to deliver on some manner of economic growth, I think that again is the biggest negative. I don't see anything other than the monsoons. Other than the monsoon, a potential for collapse in the system, I don't see that.
Right. And an interest rate cut that we've been talking about so far will only give a gentle push in the right direction.
Not a gentle, a sharp push.
Okay, a sharp push in the right direction. Sharp or gentle?
Gentle.
Okay, gentle. Ajay?
No, in my mind, other point which I would add is that the concern which still remains is that we still say not having too much job growth.
Right.
Which is a big factor, in a risk from an overall social factor from that perspective also.
Right. But if assuming at least, interest rate is obviously one of them. But assuming we get some of those things right, we'll be able to have more industrial activity and therefore
when
jobs.
investments start flowing, that will happen. Yeah.
Right. Of course, we'll discuss that once again when we meet. Thank you so much for joining me. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.